5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to you all around the world. Welcome to this episode of Follow the Money Podcast. This is actually episode number 491. We're entitling it Crypto Clarity Incoming. So we've got quite a loaded episode today. We got some big developments that are unfolding on the crypto front. Obviously, from our title today, we got Washington rolling out a long-awaited digital assets report from the White House, one that I think could really shape the next chapter of regulation in the digital asset space. We'll talk about that, break it down in segment one. We've also got M2 money supply. For those of you who like to follow the broader amount of, the global money supply, global M2 just hit another all-time high. That explains why you see asset prices rising across the board. We've also got a Federal Reserve that's still on pause despite mounting pressure from the Trump White House and from Wall Street. So in segment one, we're going to dig into this upcoming report we expect to see from the White House later today. Also, we'll talk a bit about the Federal Reserve and its upcoming policy decision and what it all means for Bitcoin and Ethereum and the broader digital asset space. And then in segment two, I'm going to take you inside the charts that I like to follow. We're going to talk commentary and market insights on the S&P 500, the U.S. dollar, Bitcoin and Ethereum, oil, gold, silver, the Nasdaq 100. We'll have several markets to look at. I'll also talk about a few of the standout stocks, ETFs, and cryptos on our leaderboards here at followthemoney.com. And then in segment three, we'll close out with some concluding thoughts. So with all that said, let's jump right into today's episode. All right, friends. Well, as we mentioned, we got a big day ahead of us today. I'm recording this podcast on Wednesday, the 30th of July, 2025. It's in the morning time, and we have not had the Federal Reserve announce its latest policy decision. We expect that this afternoon. We also expect that big digital asset paper to come out from the White House detailing how it's viewing digital assets here in 2025. So all that coming later today. I got some commentary on all of it, though, ahead of time, and that's what we're going to focus on here in segment one, along with a few other things as well. So these two major updates coming out of Washington that really could ripple through the markets, especially in the crypto space. So let's start with the Federal Reserve. Of course, the Federal Reserve is wrapping up its two-day policy meeting today. It began meeting on Tuesday of this week, and they're going to announce their latest policy decision later this afternoon. And when they do, the expectation, at least from the futures market right now, are putting the odds of a rate cut at just about 3%, right? That basically means there's a 97% chance that the Fed is going to hold steady here. That is my expectation as well. Although there is some serious pressure building upon the Fed, as you well know, President Trump has been talking constantly about how Jerome Powell needs to get with it and lower interest rates from where they currently are. He's been publicly calling for aggressive rate cuts, even suggesting bringing them down by 3 points. Right now, you know that the interest rate set by the Federal Reserve, the federal funds rate's currently at around 4.5%, right between 4.25 and 4.5. And the president would like to see them closer to 1% or 1.5%, somewhere in that range. That would be a very steep move from where we are now. That's obviously not in the Federal Reserve's plans anytime soon, at least not yet. There is an interesting report out of the Wall Street Journal this morning talking about how some of the Fed governors, particularly Christopher Waller and Michelle Bowman, could actually break ranks with Jerome Powell and call for that rate cut. So this Fed meeting may see multiple governors dissenting, which is a situation we haven't seen since 1993. Now, you have to remember Governor Waller and Governor Bowman are both Trump appointees, and so they obviously are supporting the rate cuts that Trump has been calling for, his pressure campaign upon the Fed. So we'll just have to see what comes about of that. We're likely not to get a rate cut today or this week, but we may hear that the Fed had a lot of infighting, and that could stir the market to help them see, or to help the market see that we're likely to get a Fed rate cut at the next meeting. So we'll see what all comes of this. As we think about why this matters, if you look at the national debt right now, it's sitting over $37 trillion, right? It's exceeded $37 trillion for the first time. Washington has this ongoing borrowing spree, right? And we're talking about, according to the latest data, about $323,000 in debt per U.S. taxpayer, right? Or if you just want to say per citizen, it works out to around $108,000 per citizen in America. And what's so unfortunate about that $37 trillion national debt load is that it only includes current spending, right? So it does not include Washington's unfunded liabilities, which amount to hundreds of trillions of dollars, right? And then, of course, when you think about the current interest rate levels, which this is why, the White House is barking at the Fed, is that the U.S. government has spent, more than $1 trillion this year on interest payments on the national debt. It's going to cost us over, $13 trillion over the next decade alone just to pay interest on this national debt. So this crippling debt load that America has is going to continue to become more problematic in the years ahead. It's even causing now the White House to try to force the Fed to lower rates so that it can allow it to continue spending like a drunken sailor, So it's understandable why the White House would want to see interest rates come down so dramatically, but it's likely we're going to see Jerome Powell hold the line. But the U.S. Treasury is just digging an even deeper hole. I don't know if you've heard about this recently, but in Q3 alone, the U.S. Treasury now announcing that it expects to borrow another $1 trillion in privately held debt. That is in 3 months, by the, basically from July, August, and September, just that 3-month period. Treasury expects to borrow $1 trillion, right? Now, what they're telling us is that, they're trying to replenish their cash balance. They want to bring their cash balance up to about $850 billion. But we'll just have to see. That kind of borrowing with today's interest rates is expensive, right? Wall Street knows it. Global investors know it. Obviously, the White House knows it. So the Fed is, kind of caught in a corner here. If they cut rates, then it's going to look like they're acquiescing to political pressure and bowing to political pressure, which the Fed wants to maintain this independent aura about itself. But of course, if they do cut rates, not only will they appear to be acquiescing to Trump's demands, it will also very likely fuel inflation again, right? Because we still have inflationary pressures, and when you lower interest rates, you can stoke those inflationary pressures. Of course, if they hold interest rates here, it threatens to tighten liquidity and strain debt service costs, and just continue to make these interest payments so difficult for Washington and for consumers, for that matter. Although I will say, based upon the latest data we've gotten from the GDP that came out, was a surprise number for economists, actually came in stronger than they expected for Q2. But then also the latest earnings report from Visa showed that consumer spending, not just here in the United States, but globally, continues to expand year over year. So despite the fact that we've had so many problems and so many issues and so many, just out of left field problems over the last few years, the consumer continues to spend, right? I think the Fed knows all of that. So we're looking for two things this afternoon when we see the latest policy decision by the Fed. A, any hint of dissent, right? Particularly from Governor Waller or Governor Bowman. And we're also going to be looking for any kind of comment from Jerome Powell that leaves the door open to rate cuts in Q4. And that's really what Wall Street wants to hear. Okay, so that's coming up. We don't expect a rate cut. If we get one, it will look a lot like political pressure, White House pressure on the board. It could be that Powell actually doesn't want any sign of dissent coming out of the Fed board, and so therefore he may acquiesce to their demands. Who knows what's going to happen? But based upon the futures market, there is no expectation of a rate cut today. So that's what we're looking at. Now, let's switch gears and talk about another thing that many investors are going to be watching out of Washington today. That is, we're expecting the White House to release its long-awaited digital assets working paper. And this is the result of a 180-day policy review ordered earlier this year. In fact, it was, if you've been following, there was actually an executive order put out back in January by President Trump. It was Executive Order 14178. And that executive order basically mandated the release of a report. And that report is expected to lay out new recommendations on how federal agencies will handle digital assets. They'll also be talking in this report supposedly about the guardrails around stablecoins, especially how they tie into the banking system, the role of tokenized real-world assets, how regulators plan to address them. So there's a lot here: market structure, oversight issues, consumer protection issues. The report also may include proposals for a national digital asset stockpile and a strategic Bitcoin reserve, which I think would also be very bullish for many people who are watching that space. The goal with this report, hopefully, is to clarify and not confuse, but we'll just have to see. If the report takes more of a heavy-handed approach, it could lead to a sell-off in digital assets, which, quite frankly, I would consider a pretty bullish moment for those who want to buy. I would like to see a broader pullback in the broader market as I continue to dollar cost average into my favorite crypto projects, even now, even in 2025, even though we've been doing it now for, nearly, well over a decade at least. We just continue to. Now, if the report comes out and it really supports innovation with a clear regulatory framework, then that could really give a boost to to many crypto assets, especially Bitcoin and Ethereum. As we look at Bitcoin and Ethereum this morning, for context, Bitcoin sitting at about 118,000 as I record this. Ethereum sitting right around 3,800 as I record this. When we think about space, especially Ethereum has been getting seen a big rally in the wake of the stablecoin legislation, which was passed and signed into law not too long ago. And what we've been seeing, of course, is this push into crypto assets by Wall Street as they expect the White House and Congress to continue to push forward and make it much easier institutional investors and retail investors to take part in this asset class. Now, you've heard about Bitcoin treasury companies, right? You've heard of things like MicroStrategy, which has now been rebranded Strategy, run by Michael Saylor, where they actually created a Bitcoin corporate treasury, right? So for years, Bitcoin has been the go-to crypto asset for public company treasuries. Michael Saylor, of course, being one of the leaders in that space. He's been adding Bitcoin to the Strategy corporate treasury for some time. I think since, certainly over the last few years. There's a really interesting website too, bitcointreasuries.net, that shows a list of all of the various global entities, which there's more than 100 now, that hold sizable amounts of Bitcoin on their balance sheets. And that figure just keeps growing by the day. But there's a pretty quiet shift that's been taking place in recent weeks, especially around the stablecoin bill. When we think about stablecoins, those are actually largely, not all, but a large amount of the transactions in stablecoins takes place on where? Upon the Ethereum blockchain, right? So Ethereum is really at the center of much of that. And what we're seeing now is that corporations are buying Ethereum at a faster pace now than they are Bitcoin. In fact, two of the top ETH treasury holders now, we have Bitmine Immersion Technologies, that's ticker symbol BMNR. That's run by the famed Wall Street analyst Tom Lee. And then also SharpLink Gaming, SBET ticker symbol. That is run by Joseph Lubin, who is a co-founder of Ethereum. So he is wanting to have his firm, SharpLink Gaming, actually be the top. He wants to basically be the Michael Saylor of Ethereum when it comes to corporate balance sheet strategies. But you also have Tom Lee, who wants to do the same thing. And you have other companies that are coming. And you have new players like the Ether Machine that are making bold moves, aiming to become dominant holders of Ethereum. So there's really kind of an arms race here for companies to build out these Ether corporate treasuries. And we're seeing this grow pretty quickly. In fact, there was a report that was put out that showed that over the last month, just since the month of June, corporations have already acquired 1% of the total ETH supply. And Standard Chartered, a bank, pretty popular bank, is forecasting that corporations could soon gobble up around 10% of the total ETH supply. So that is pretty interesting. That, of course, will have a very positive impact upon the price of ETH over time. So that demand continues to come in. We expect that we're going to see a lot more in the way of price action going higher for Ethereum and for Bitcoin as well. So more DAOs, more DeFi protocols are holding ETH as part of their treasury reserves. It's not just the stablecoin growth that's really leading to this. And this really signals a growing trust in ETH as a monetary asset, similar to how we saw Bitcoin kind of evolve as digital gold. I always thought that Ethereum would be actually more popular on Wall Street than Bitcoin. Bitcoin kind of beat it to the punch, but I think you're going to see incredible mass adoption. This is just my opinion. I think that you're going to see this, though, over the next 5 years. I would expect that Ether is going to become a very dominant crypto in terms of Wall Street and institutional holdings. And the reason why I say that is because Ethereum does pay a staking yield, whereas you don't get a yield with Bitcoin. They've had to come up with innovative ways to generate income from Bitcoin because it really wasn't designed for that. Whereas with because of the consensus mechanism, Bitcoin is based upon the proof of work mechanism where miners are the ones who get the rewards. And you may recall it was a few years ago where Ethereum was based on that same kind of consensus mechanism, proof of work, but it moved to proof of stake. And by doing that, it began to reward stakeholders. So those who hold ETH and then stake it are able to receive a reward. It's akin to like a dividend when you hold a stock, and they can compound over time. And so to me, Ether is just one of these superior assets in that respect. And I think Wall Street sees it, and I think that many of them are trying to get on the bandwagon. So I think it's going to be a very interesting few years here for Ethereum as we go forward, and Bitcoin, of course. Also worth watching here before I bring this first segment to a close, also worth watching, M2 money supply just hit a brand new all-time high. So we have liquidity awash in the system right now, even though the headlines don't always seem to say it, but you'll certainly see it in the stock market. If you've been looking at the stock market or the crypto market, you've been seeing new all-time highs, the S&P 500 at all-time highs, the Nasdaq 100 at all-time highs. You saw gold recently at all-time highs, Bitcoin at all-time highs. I mean, just go down the list. NVIDIA's at an all-time high. So what's going on? Well, M2 money supply, as it expands, it creates a lift for all risk assets, right? So that's why we see stocks and crypto and gold, all near or at all-time highs. And this is one reason we've seen strength, of course, in Bitcoin and the broader equity markets, despite the fact that we've seen weak economic sentiment across the board in many different areas. So you take that backdrop and then you combine it with the momentum that we're seeing in artificial intelligence, and then, of course, the expectation of coming interest rate cuts, and then, of course, the $7 trillion that's sitting on the sideline in money markets right now, earning, relatively little amount of interest. So as rates come down, that number is going to go lower, and we would expect to see a flood of cash coming into the markets from the sidelines over the next few years, especially as we get into the rate cut scenario, which is probably just a handful of months away. So there's a lot to watch this week, as we said, and even today. So we will see the Federal Reserve announcement later today. Again, we don't expect a rate cut today. We could get a surprise. And if we do get a surprise, watch out, because that could be a very interesting story. And then secondly, we're waiting for that paper to come out from the White House regarding digital assets. That should be pretty market moving. It may already be priced in. It all depends what's in that paper. By the way, if you are new to the digital asset space, you're new to crypto, and you just want to get some basic information, we just released a brand new video for our members called How and Where to Buy Bitcoin. It's a very simple walkthrough to help you get started or sharpen your process. We share with our members our favorite exchange to buy from as far as price. It saves you a lot of money. And we also talked about step-by-step how to go through buying it. It's quite interesting because even though crypto's been around for so many years, we've noticed this year, especially this year, we have received more questions about how to buy Bitcoin or how to buy Ethereum or any of these, projects, more so than I can almost remember. It's almost as if the adoption now is really accelerating, and so to us, it's a market signal. So we went ahead and put out a good video. It's for our members, giving all the tips and techniques and everything. So anyway, if that's something that you would like, become a member. It's right there in our member dashboard as we speak. That brand new video. Just go to followthemoney.com/join and just choose your plan. The gold and the platinum plan have access to all of our crypto information, especially that brand new video. So be sure to check it out. All right. Well, on the other side of this break, we're going to turn our attention to the charts. We're going to provide some market insights. I'm going to go through several different charts today, and we'll talk about what's happening in the broader market. I'll share with you what I see across many different markets. Stick around.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, let's take a look at the charts. We're going to take a look at the broader markets now and provide some insights for you. Taking a look at the S&P 500 index, we always like to start there because the S&P 500 index is, I think, the most important global measure of the U.S. equity market, both by domestic investors and also foreign investors. In fact, research by William J. O'Neill, who created Investors Business Daily many years ago, actually concluded that 3 out of 4 U.S. stocks move in the direction of the trend of the S&P 500. So it's so important to monitor if you trade or invest in U.S. stocks. And right now, the S&P 500 is sitting just a hair below its recent all-time high. It's sitting well above a rising 50-day moving average. The major support area that we would be watching right now would really be around the 6135 area or so, 6130, somewhere in there. I think that area is likely to hold, although we have had such a robust rally since the 200-day moving average breakout that occurred back in the early part of May after we had very sharp low in April. April 7th, of course, was the low for the markets, but we have had an incredible V-shaped recovery that took us right past all-time highs last month, and now July has just been filled with many new all-time highs on the S&P 500. So it looks very good. Due for a pullback, certainly, probably again to that 6130 level or so. That would probably be the key area I'd be watching. But for now, it looks very well positioned. And right now, the markets are a little bit skittish ahead of the Fed decision. So we'll see how things work out after the Fed announces. And also, it might depend also on how much they're telegraphing future rate cuts. If they're hinting that they're imminent, maybe coming up at the next meeting or so. We still expect 3 rate cuts this year, and we think we will see those as we close out the year, especially in the last quarter. Now, if you look at the percentage of stocks in the S&P 500 that are trading above their 200-day moving average, a pretty good metric to follow for market breadth, you'll discover that it's around 63% of stocks that are trading above their 200-day moving average in the S&P 500. So that means about basically 2 out of 3 are in bullish territory. And that is certainly not overheated. That's not an area where we would be concerned about, too much breadth, indicating we're probably due for a broader pullback. And so right now, that looks pretty good. If you look at the Nasdaq 100, QQQ, this is my own trading niche. The Nasdaq 100 over the years, I found it to be a profitable market without that single stock risk. So I do like to trade around the Nasdaq 100. I like to trade around my own long-term position in the Nasdaq 100. You can also use leveraged ETFs like QLD, which is a 2X, or TQQQ, which is a 3X. Those are obviously highly complex, specialized products. You should avoid those if you're an inexperienced trader. You really want to learn more about leveraged ETFs before you ever use them. But I do like to use those to trade around my long-term position in the Nasdaq 100. And right now it's sitting, again, just a hair below an all-time high as we speak. Again, on that level, if you're watching QQQ in particular, I'd be looking for 540 or so to be an area of pullback. Right now we're trading at about 569 on QQQ. Turning to gold. Gold is also continuing to kind of churn sideways. We had such an incredible rally in gold, and now it's been really hovering above that 3,300 level, but it's still trading below its $3,500 all-time high. This is a fine place for gold to be, in my opinion. I think that the fact that it hasn't pulled back more sharply is somewhat, probably not too terribly surprising, but it is holding itself very, very well. It is historically overbought, obviously. If you've been following that market, it's really due for a pullback. I would expect it to pull back anywhere between the 2,900 range and the 3,200 range and maybe hold there for a little bit before it tries to make a new all-time high. But we'll just kind of have to see. It really will be dependent upon a few different areas of the economy. And also, when we look at the gold-silver ratio, still very favorable to silver, sitting at about 87 right now. Once you get up to about 100 on that ratio, it's really bullish for silver. Once you get down to about 50 on that ratio, it's very bullish for gold. And right now we're about 87. So it's still boding very well for silver. We think there's more upside for silver in this current environment. Although silver is pulling back, maybe we should talk about that next. Part of that has been due to the resurgent U.S. dollar. I'll talk about the dollar in a minute, but silver has pulled back. It's trading at about $37.75 as we speak. It came up to the $40 level, came within a hair of it, and then started pulling back. So not a surprise there. But again, that also coincides with the broader rally in the U.S. dollar index. So the dollar had been falling for, as you probably know, we've been talking about on this broadcast, but also to all of our members, we've been following that dollar because it really matters for investors and traders. We kind of peaked out right before the inauguration And then it began a steep decline from about 110 on the dollar index all the way down to about 96 and change. Okay, that happened over, just 6 months or so. It was a dramatic decline in the US dollar. It got down to a trend support area, and I told our members to expect a rebound up to the 50 SMA. Well, we got that. And then we pulled back again, and then we got another rally. The market seems to be showing some strength here in terms of the dollar as we head into the Federal Reserve, meeting. So we might get a little bit of relief to the downside on the dollar after that meeting, especially depending on what's said. The Fed really drives that dollar index, and so we'll see what happens to be said in the wake of that meeting today. But right now, the dollar pretty resurgent, and that has to be serving to dampen silver at this point. But again, right now, the dollar is sitting at about 99.50. There's major resistance in the 100 to 101 resistance zone. So I don't really expect, barring some sort of oddball statement out of the Federal Reserve today or anytime in the next few days, I can't really see it getting too far above that. So I expect the dollar will begin to pull back. That should provide a lift for some of these other markets like we were talking about, like silver, right? Russell 2000 also very tepid rally here. It struggled to regain. It hasn't really done the V-shaped recovery fully. It's almost back to where it was at the beginning of the year. It's actually above where it was at the beginning of the year, but it's still trading below its highs for the year. And it's also trading well below its all-time high that was set last year. So there's still plenty of room for small caps to rally. But again, that has been a very tepid rally. And so we'll continue to monitor that one as well. China has really had a great rally this year. It's one of the top performers in terms of broad global markets. The Chinese market really looking nice on the equity side. And then oil has been breaking out. Oil, if you look at the price of West Texas Intermediate, it's back at $70 for the first time, in many weeks. Same thing with crude oil, the Brent crude oil price. That's about 73 as we speak. We've also seen gasoline prices tick up just a little bit over the last few days. It's kind of come along the same time with that dollar resurging as well. So oil looking fairly interesting here. It's starting to perk up a bit. It's really been oversold now for some time when we look at the price of oil. It's really been much lower than what we've been seeing. It's been really helping corporate earnings because, of course, energy prices are an input for everything when it comes to costs. And so the oil price is picking up a little bit here. We'll keep an eye on that. Now, let me close out with just a few comments here on Bitcoin and Ether, because Bitcoin, again, trading just below its all-time highs. Remember, it hit that high of about 123,000 not too long ago, earlier this month. It's pulled back from that area. It's trading as we speak right around 117.7 or so, 117,700. And if you look at the broader, say, the daily chart, the real key support right now is in that 105 to 110 level. And then certainly at its 200-day moving average, which is currently at about 99,000. There's plenty of more upside, in my opinion, for Bitcoin this year, especially as we begin to get into those rate cuts. And Ethereum also has had this incredible rally since the beginning of July. If you go back to the beginning of July, the price of Ethereum was sitting below, right around $2,500. Today, it's $3,800. So when you think about that, that's been an incredible rally that took us past a really key resistance area, which was about 3,300. That was an area that we had lost at the beginning of the year, and then we just retook it. And now we're trading at the highest level of 2025 as we speak. We are still about $1,000 away from hitting a brand new record high on Ethereum. And I don't think that's out of the question this year. I think we're going to see a record high on Ethereum this year. I think we're going to see it. That's something we're watching for. We are very bullish on that project. We see a lot of good things ahead in terms of price appreciation, staking income, and just general adoption across the board when it comes to Ether. So just a lot of moving charts we're looking at here today, and it looks like right now everything is looking very bullish. We are off of highs, but we're still very, very bullish here in terms of trend performance. We provide ongoing updates to our members every weekend in our Robinson report. I put out a PDF report. It talks about all the different trends. We have ETF leaderboards, sector leaderboards. We have the crypto leaderboard, and it really helps keep our members on the right side, of the trend. And just talking about a couple of the latest leaders right now in this current environment. Right now, sitting at the very top of our crypto leaderboard is Tron. Tron, TRX, has really had quite an interesting run over the last several weeks. In fact, it just hit 34 cents yesterday, which is the highest level we've seen in quite some time, except for those just really quick intraday peaks that we'll see sometimes. But just on a sustained level, Tron currently leading our crypto leaderboard right now. Ether coming in number 2, Binance Coin coming in number 3, Bitcoin Cash coming in number 4, and Bitcoin coming in number 5. What we do is we also provide suggested stop losses for our members, so they can see the leaderboard, they can see how the rankings change on a regular basis, and then they're also able to see what we suggest is a stop loss for the top 5. Very, very helpful info for those who like to follow that space. Over on the ETF leaderboard, we track, about 150 of the most popular ETFs out there. And believe it or not, sitting at the very top of our leaderboard right now is Greece, ticker symbol GREK. Now, this is the Global X Greece ETF. We've seen it pull back just a little bit. It's had an incredible rally this year, rallying about 56% year to date. Another global market that's sitting near the top of the ETF leaderboard coming in number 2 is the VanEck Vietnam ETF, ticker symbol VNM. That one has done very well this year. Vietnam up around 39% year to date. And then we also have Spain, which has really been one of the perennial winners. One of the big winners, I should say, this year, especially in Europe. It's up around 44%. I mean, that's just trouncing the S&P 500, which is up, I say 10% or so year to date. So we've seen a very nice rally there in ETFs. We also track dividend aristocrats. We have an aristocrat leaderboard. Emerson Electric sitting at the top of that leaderboard right now. EMR, it's had a really great run. Also Fastenal, ticker symbol FAST, and Caterpillar, ticker symbol CAT, coming in number 3. All of those have had a really great run, but also trend-wise, they've been looking very interesting. I'll also mention just real quickly on our sector leaderboard, we'd like to follow all 11 sectors in the S&P and rank them according to our proprietary ranking system. And right now, industrials just sits on the top. It's been there for some time. XLI is the ETF we use to track the industrial sector. XLK is the tech sector that comes in number 2. And utilities, which has really had a great run this year and plenty of, I think, upside ahead in the coming years with the AI, generative AI demand, the data centers and all of this. XLU coming in number 3 right now on our sector leaderboard. So there's just a quick overview of some of the charts we're looking at, some of the key levels we're watching, and some of the leaders in our leaderboards. Again, if you want access to all of the investing and trading research that we provide to our members, and it's a lot, just go to followthemoney.com/join. We'd love to have you become a member. And with all that said, we'll come right back with our final moments. Hold tight. All right, friends, welcome to the final moments of today's broadcast. Let's wrap things up here. As we've said, there's a lot happening beneath the surface right now. We got new crypto policy direction coming out of Washington this week. We'll see how meaningful it is. We also have a Federal Reserve that's trying to save face as it announces its latest policy decision, which we expect to be no rate cut unless we get a surprise. And then we're also dealing with global M2 money supply quietly hitting new all-time highs. It's leading to a rising tide in asset prices that are really driven a lot by liquidity, a lot by fundamentals, but increasingly by the amount of liquidity that's in the system. So this is one of those moments where discernment really matters. The noise is very loud out there, but if you know where to look, if you're watching the charts, if you're tracking the money supply, if you're following the flows, then you really can stay ahead of the crowd instead of reacting to it. And that's the whole goal of our work here at followthemoney.com. We don't chase hype. We really seek to help our members map the terrain and then help them navigate it with a clear head and a long-term view. And that brings me to our final word today. I like to leave you with a final word here on this broadcast. One of my favorite lines from Warren Buffett, and it's never been more timely. Mr. Buffett once said, quote, "Only when the tide goes out do you discover who's been swimming naked," unquote. Right now, the tide is shifting, friends. Liquidity has lifted a lot of boats this year. But if that liquidity dries up or if policy and sentiment turns, then we'll find out who built on sand and who built on rock. And that is just something to think about. Well, once again, friends, thanks for being here. And again, if you're not already a member of our investing club here at followthemoney.com, I encourage you to come join us. It's a great time to join us in 2025. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.